So, we're hearing a lot right now in the mortgage and real estate world about how we can help more people to afford a home. Obviously, home prices are very high. Interest rates are starting to rise. It's the end of March here in 2022, and there's just a lot of people that are having a hard time buying a house. We're starting to see some of the lenders coming out with different product types that kind of just expand the credit window, which means they're loosening up their guidelines. Which, well, that's something that is admirable. Of course, we want to try to make more opportunity for people to buy homes, especially the first-time buyer that's looking at these home prices and mortgage payments and feeling maybe a little bit helpless. But I want to take a little bit of time and just help people really understand what's missing. And really, it's education. So really, it's that I think that our society and even our education system right now is just not putting enough emphasis on the basics of finance, the basics of the things that you need to know, just running a household, growing up, I guess, and starting to get out into the real world. And one of the biggest things about all of that, aside from balancing your checkbook or understanding credit cards and things like that, is what does it really take to buy a home? Because if you were to look at a lot of the statistics, or if you were to pull some books, I mean, there's a book called The Automatic Millionaire, which I read years ago in hopes of, finding the holy grail of how to become a millionaire. Ultimately, what it said was, most millionaires, average millionaires, and this was 20 years ago at least, really are millionaires because of the fact that they bought a home and they kept that home when they bought another home. Okay, so they bought their starter home, and then eventually they saved up enough money to move on to their move up home, their second home, but they kept the first house and they rented it out. And maybe they did that again. So maybe they have 2 or 3 pieces of real estate, and this is over their lifetime. Okay, so this is not like it happened in 10 years. Like you hear a lot right now about everyone buying all these houses, and that's an option during certain markets. But in general, the person that has a regular job, that makes the average income, you got a husband and wife working hard, trying to pay their bills, they buy a house, over time, they're ready to move up to their next house. They find a way to keep the house that they had originally. So they build up a down payment for this next house. And that's really how people in general become millionaires, by the amount of assets that they hold. So the number one thing that people need to do, really, in my opinion, is buy a home. Okay, like even probably before your 401k, is buy a home, because you have to make the payment. It's a forced savings plan. And because of inflation, the house prices continue to go up, which makes them more difficult to buy later. And all of a sudden you're building equity in the home that you bought today. Okay, so I always recommend that. But what does it take to buy a house? And really, there's only 3 things that you need to understand about it, but you need to take them seriously. And if you take them seriously, you can put yourself in a position to buy. We don't need to create a new product to make it easier to buy a house. We need to make sure people understand what it takes to buy a house with the products that we have today. Because if we broaden the credit window, so to speak, what they're calling it, then are we also putting those buyers in a more precarious situation to possibly not being able to afford this house, and maybe end up having foreclosure, which is the total opposite of what we want for our home buyers? We want them to stay in the house and to build equity, to build wealth, and to thrive. So we want to make sure that we're selling houses at prices with mortgage terms that still fit the client. So really, there's the 3 things that you need to understand when it comes to getting qualified to buy a home. Most people are not buying cash, right? The thought process that you hear from some of the finance gurus about you need to put 20% down and use a 15% loan. Hey, that would be wonderful. But I can tell you right now, I probably couldn't do that myself. It's very difficult to come up with that much cash. And you don't really want to wait that long before you get into a home. You don't want to wait 30 years of saving, because cash is a whole nother conversation, but cash is diluted by inflation. So you want to put your cash into inflation protected assets, and a home is the first thing. So the 3 things that you need to understand that you're going to have to pay attention to in order to buy a house. Number 1 is going to be your credit. I mean, this is not new, right? You need to have good credit and you need to build good credit. So you don't just, if you are an 18-year-old and you pull your credit report, you don't start off with perfect credit and then you lose the credit if you miss payments. You start out with no credit. Okay, so you have to build credit. So for instance, when I was, getting into the world and decided I need to build my credit, I got what's called a secured credit card. Okay, so a secured credit card is, I went to a bank and I said, I'd like a credit card. And they said, well, you don't have any credit. We can't give you a credit card, but we'll give you a secured credit card. And what that is that I want to say it might've been Capital One. I don't remember who it was, but I gave them $300 and they took that $300 and they kept it in a savings account. So I now had a savings account with $300 in it, but I couldn't touch it. It kind of like wasn't my money. And they gave me a credit card with a $300 credit limit. So if I didn't make my payments, if I racked up that credit card and I didn't make my payments, that credit card company would just keep the amount of money that I put in that savings account. So it was like they were insuring themselves, so to speak. So the secured credit card is a great way to start building credit. And yes, you're going to have a few $100s. You go to a company, you give them that money, they're going to hold on to it. And then now you have a credit card. So you buy a tank of gas, you buy a shirt on your credit card, and then you pay it off at the end of the month. And then you buy a tank of gas and you buy another tank of gas, and then you buy, dinner, and then you pay it off at the end of the month. So this is money that you would already be spending that you start using a little bit on your credit card, but you pay it off every month. You don't accumulate debt and if you don't accumulate the debt, there's a good chance that there will be zero interest, because as long as you pay off full balances at the end, normally credit cards charge you zero interest. So there's no sense in not doing that. And also you're teaching yourself discipline, right? You're saying, look, I got to pay this thing off. So there's multiple reasons why you need to do this. You need to start building your credit. And I would say that you probably want to have maybe 2 or even 3 of these credit cards to start building your credit score. Usually the next thing that someone does is they go buy a car, right? And cars are going to be like, okay, we'll give you a car. They always will sell you a car, a used car especially, but the interest rate's 14%. Okay, well, maybe you need to do that as well, because you need to start building your credit. And building your credit, I mean, you really want to give yourself a year. I mean, you may be able to start getting some FICO scores that make sense after 6 months, but a mortgage company is really going to want to see more of a year. So keep that in mind. You need to get started on that. And I think you're going to have to be 18 to really get the ball rolling on that. So you go out and you start building your credit. Now, what credit scores do you really need? Well, realistically, you really have to have scores above 620 before you really start to have some product available to you. There's FHA, which will go lower than that, but your interest rates are going to be so high. I mean, if your credit score isn't really in the high 6s to the 7s, maybe it's not time yet. Maybe you need to keep building your credit, because you want to try to get the score up high enough that you get a hold of some of the better interest rates. Okay, so credit is number one. Look, if you don't make your payment, like, think about it. If you can't make your payment on a credit card, do you really need to have a mortgage payment that is, $2,000? Maybe not, right? So this is a really good way to be real with yourself on learning how to make these payments and manage your money, and you build your credit. So credit reports do not include things like, I mean, they don't normally include things like your cell phone bill and electric bill or anything like that. And normally they don't even include your rent if you are renting from an apartment complex or something like that. So they don't normally report to the bureaus when you rent from an apartment or something like that. You can have that added manually if you wanted to, but normally they don't report. Now, if you don't pay your rent and you are at an apartment complex, they will then report that you didn't pay your rent, and they will really damage your FICO score and your credit history. So credit is made up of 2 things. It's made up of your score, which is a generalized score that the credit bureaus calculate with what they call algorithms. And also the second thing that we're looking at is the individual credit lines, your true credit history. Okay, so if you have an 800 perfect FICO score, but I go in there and I find out that you somehow had a bankruptcy a year ago, we're probably not going to be able to get you a loan. Okay, so both matter. So building your credit obviously is very important. The second thing that you need to pay attention to is your income. So what we're going to look at, and there's videos that I've posted here that break down these different things like debt ratio and things like that, but I'm just giving you a generalization. You need to have income. Okay. So take your gross income and cut it in half. And take that half number. If you make $5,000 a month gross before taxes, cut it in half. Now you're talking about $2,500. Subtract out your liabilities like your credit cards, your car loans, and things like that. And whatever that balance is after that is really where you need to have your mortgage payment sit. You need to have your mortgage payment in that range. So, if you make, let's say you make $4,000 a month and you want to buy a $500,000 house, it's not going to happen. Like that just, it doesn't make sense, right? Like you're going to have too hard of a time making the mortgage payment consistently, and mortgage companies want to know that they're going to get paid. Okay. So income is number two. So you need to go out and you need to have a steady job that you're usually, almost always it needs to be full-time, and you need to have a steady income. They really want to see that you've had steady income for 2 years. Okay. So if it's less than 2 years, maybe, but you really want to have a steady income for a couple of years, and then let the mortgage company look at that and see what we're going to calculate for your income. Okay. So again, it's something to get started on. And should you change jobs from one employer to the other? You try not to. If you have to, if it's in the same line of work, if you were working for, Macy's, and then you're going to go to work for Aeropostale, or if they're still around, or American Eagle or something like that. So a clothing company retailer to a clothing retailer. Okay. You're probably okay. But remember, if you want to add overtime and all that into your income numbers, we need to see a 2-year history. So we're going to average out over 2 years. So pay attention to that. Now, if you get a job, you get out of school, you go get your nursing degree, you now have an RN degree, and you go get a job at a hospital, and you've been there for 4 or 5 months, you're probably fine, because we're going to use your schooling as the history. So keep that in mind. Something that you want to talk to a mortgage person about, like myself. But income is obviously the number 2 thing that you have to pay attention to. The number 3 thing is what we call assets. So that's money that you have in the bank. And these days, assets are probably the biggest obstacle to people getting into homes. So it's funny that there's still this crazy thought in general in the United States. People think that you need 20% of the home price to be able to buy a home. So if you're buying a $100,000 house, you need $100,000. If you're buying a $500,000 house, you need $100,000. So that's what people think. And that's just not the case. Okay. So most people are not putting 20% down when they buy a home that I see, the people that I work with. You can buy a home with a standard conventional loan if you're a first-time buyer and you have good credit for 3% down. So there are programs for 3% down. There is another very popular program, which is called the FHA program. That's the Federal Housing Administration program, that requires 3.5% down. Okay. So those are really, really good products. As you start to put more money down, like 5% or 10%, maybe you get a little bit lower interest rate, a little bit lower monthly payment, but you really only need to have, say, 3% down. Down payment assistance programs. Are there down payment assistance programs? Yes, there are. Are they helpful? Sometimes. So just because you're a first-time buyer doesn't mean that you're going to get some super low interest rate and have no money down. That's not how it works. Okay. So if you're going to have no money down, then most likely you are a higher risk to the lending bank. What do they do with higher risk? They charge a higher interest rate. Okay. So normally there's going to be something that offsets the benefit of a down payment assistance program. That's just the reality of it. So you may have a higher interest rate, which gives you a higher payment. Some of the down payment assistance programs have limits on how much income that you can make. So they want to make sure that it's for not low income people, but not people that are making hundreds and hundreds of thousands of dollars. They also have, FICO score requirements. So again, if they're going to have the risk of you having no money down, so they call that no skin in the game. You have put none of your money down. So if things go bad, hey, just walk away, right? I'm not going to lose anything. Like, oh, well, my credit gets down. They don't like to see that. So if you're not putting any money down, then you are considered a high risk. So on the other side, they're going to say, okay, maybe you're going to have a little bit higher interest rate because it's higher risk. And I need to see that you have good credit. You need to show me something that makes me feel confident that you're going to be a good risk, that we want to lend you this money. Now they're doing what they can to help people. Down payment assistance programs are usually something that is sponsored by either a state or some other entity that is trying to help fund people that need help with their down payment to get people into homes. Okay, so we can always look into a down payment assistance program, but quite honestly, in today's market, it's going to be very, very difficult. And I say that even liberally. I don't want to say it won't happen, but it's going to be very, very difficult to get your offer accepted in a hot market when we're having to tell them that we're using down payment assistance, because they are going, well, maybe I can find a client that is a little bit more qualified. So whether that's true or not, it depends. That's up to them. They're the seller. So those are the three things that you need. So if you were to say, look, I have, money in the bank. You need to have money in the bank. Even if you use a down payment assistance program, you're probably going to have to make what's called a deposit, an earnest money deposit, which is usually 1% of the purchase price. So if you're buying, again, a $500,000 house, that's $5,000. You're probably going to have to pay for some of your closing costs, which closing costs can vary from state to state and different program to different program. But it's not hundreds of dollars, it's thousands of dollars. Okay, so you're going to have to think about, how can I get a hold of, let's just say, bare minimum, you say, how can I get a hold of $10,000? If you are in a little bit higher priced market like California or Florida, something like that. Now, if you're buying a house that is $120,000, you're not going to need that much money to get into a house, but you're going to have to start talking to a mortgage professional like myself or someone in your market. It's going to be able to tell you how much cash you need. But the point is, what I really want to do is I want to try to educate, and I'll do more videos with more detail on these three topics, but I want to try to help people understand that you need to have good credit. You need to have consistent income, and you need to be able to save some money and put it in the bank. Okay. So think about, if you're a bank and you're lending money to someone who says, I have no money in the bank. I have zero money in the bank. I have $100 in the bank. Well, how are you going to make your monthly payment? Like, what's your rent? Well, my rent's $1,000 a month. Well, how much is this new mortgage payment? It's $1,500 a month. How are you going to make that $500 discrepancy? And I don't need you to make that $500 discrepancy for 1 month. I need you to make it for 360 months, which is 30 years. So if you think about it that way, you start to go, okay, I get it. But again, there's a lot of people that don't know the three things that you need. You're going to need to have the income, the credit, and the assets in order to buy a home. I want everyone to understand this, because I want everyone to be able to buy a home. Buying a home is paramount to being able to someday have some sense of security in your finances. So you need to understand that those are the three things. If you have more questions, we could go into this for hours and hours. Watch some more of my videos that I'm going to break down the income perspective, the asset perspective, and the credit perspective a little bit further. Let me know what credit or what questions you have. So leave a message down in the comments below. I'd be happy to get back to you. If you want me to talk about a specific topic, I'd be happy to do that as well. But let's try to find a way to help people be more educated in the basic finances of what goes on in the United States, which is like, what does it take to buy a house? How much money do I really need? These are things that should be, in my opinion, being taught thoroughly in the public school system, but for some reason, it might be talked about for a day, if at all. These are things that really we need to be teaching people how it works. Again, let me know if I can help out. I appreciate you. Make sure that you like, share, and subscribe to this channel. Have a great day.